A bank hands you a loan with almost no strings attached, then acts shocked when you stop paying back. It sounds backwards, but that shock, that's the core of moral hazard, and it's one of the lending industry's most expensive blind spots. Let me show you how this worked, starting with a decision made quietly in 1980s boardrooms across America. Before that decade, lenders kept skin in the game. If you defaulted, the bank that originated your mortgage held it. They lost money directly, so they were careful, very careful about who got approved. But then something shifted. Banks started selling loans off immediately. They originated the loan, collected a fee, and passed the risk to someone else entirely. Now here's the irony right here. Once the originator doesn't own the risk anymore, the incentive to vet borrowers evaporates. They're not losing sleep over defaults. They're making volume commissions. Approve more loans, collect more fees, move on. The person holding the actual bad loan, a pension fund in Connecticut, a mortgage-backed security buried in someone's retirement account. This is moral hazard in its purest form. When your actions carry no consequences for you personally, your behavior changes. Not because you're evil, because you're rational. You have no reason to be cautious. And neither does the borrower, honestly, once they realize the lender approved them for an amount they can't sustain. The system created mutual hazard. Lenders had no incentive to say no. Borrowers had no penalty for saying yes to impossible terms. And everyone in the middle, the servicers, the securitizers, the rating agencies, had a financial interest in pretending the risk didn't exist. This structure didn't cause the 2008 crisis alone, but it made the crisis possible. Millions of subprime mortgages that should never have been written were written because nobody writing them would face the consequences. The hazard was baked into the architecture itself. And here's what's instructive. Moral hazard isn't about morality. It's about incentives. Align the incentive, make the lender hold the risk, or make the borrower fully understand it and behavior shifts. Misalign them and you get systemic disaster. That's not opinion. That's how the system was engineered and how it broke. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for more histories of how lending systems were built and what went wrong, so you can see these patterns before they repeat. This video is for educational and informational purposes only and is not financial advice. Always do your own research.